Hello, my name is Manesh Patel. I'm from ichimokutrade.com. Today's workshop, what we're going to do is go through one of our trades that we took, and we're going to give you the entire thought process from the very beginning to the very end. Before we begin, I want to give you a background on myself. Started off as an engineer in 1996, graduated from the School of Electrical Engineering from Georgia Tech. Basically, I was an engineer until about 2007. At the end of 2007, I retired from the telecom field and got picked up by an institution to manage currencies and stocks. Eventually became the CTO for that firm that did high frequency models. They did 40,000 trades per second. At the end of 2010, I left that firm and pretty much I've been managing my own money today, where I trade pretty much any instrument around the world. I go where the trend is, using Ichimoku Kinko Hayo, a Japanese trend-based system. If you look at the statistics here from Bloomberg here, you can see Ichimoku is ranked number 6 in the world now as the most popular indicators, and it's gaining more and more momentum as more people learn more about it. Before we do go for the trade review, let me go for our normal disclaimer to state this is for education use only. We're not soliciting you to buy or sell any particular instrument. All information is owned by EII Capital Group, cannot be copied or distributed without permission from EII Capital Group. We're going to be using various charts from Thinkorswim, from TD Ameritrade, TradeStation, and eSignal, and that's because we're broker neutral. Before we begin the trade review, I want to go for a background of Ichimoku just in case if you don't know anything about Ichimoku. Ichimoku gives you two different things to a trader. First, it gives you the ability to determine whether an instrument for any time frame is bullish, bearish, or consolidating. And the second thing it gives you is a clear understanding of where the key support resistance values are, where basically something can be bullish 1 minute or bearish. Okay, so let's go for the sentiment part first on how to determine if instrument's bullish or bearish. Here's a simple Ichimoku chart here, and this cloud varies based on the different brokers that you use. What you're looking for is price, the current price, and you're looking at above or below that price. If price is above the cloud, the sentiment's bullish, as is in this example. If price is in the cloud, the sentiment's consolidating, and if price is below the cloud, as in this example, basically the sentiment is bearish. The second thing Ichimoku gives you is clear understanding of where the key support resistance values are. So what we're going to do is we're going to show you a Ichimoku chart without price. And if you look here, there's different lines here. What you have is this this red line here that basically represents support resistance for 9 bars. The green represents support resistance for 26 bars. The white represents roughly a support resistance for 18 bars, and the yellow here represents support resistance for 52 bars. The key thing to note is that when these lines are flat, they represent key support resistance values. The most important support resistance value is the yellow line, second is the green, and then so forth. Okay, so let's begin the trade review. Before we go through and discuss the trade in detail that we took, we need to go through and give you an overview of what our thought process was and what we're looking for and why. Okay, so first, what we're looking for was a U.S. stock, and we're looking to buy that stock with options. Now, you do have an option to buy it with stocks, but we basically wanted to do it with options. So the overall market was bullish, and what was happening is that the first pullback was starting to occur, and that's one of the reasons why we're starting looking for stock opportunities. The position one we wanted to have is that we wanted to hold a position for at least 1 to 2 months for us, because this wanted to be a long-term play instead of a swing trade or a day trade for us. Since we're dealing with options, we wanted to deal with stocks above $30 and above, and that's due to we were going to trade with options instead of buying the stock straight out. Next, we wanted to deal with stocks that have high average volume of over 500,000 and above, and that's the reason why is that we wanted to make sure there was liquidity behind that stock, and it's something that's traded almost every day. As we mentioned, we wanted to basically trade it with options, so options have to be available. And also we wanted to make sure there was dividends behind it, because a lot of people do sit there and buy stocks with dividends, so it kind of makes sure that it can have a catalyst to go up. Okay. Now, since we're looking for a long-term position, 1 to 2 months, we started looking for scenarios where the monthly chart was bullish, and we're looking for a pullback to the weekly support. Okay. Once we got the pullback to the weekly support, what we wanted to do was we wanted to start watching the lower time frames and start seeing them go bullish from the lowest time frame to the highest. And that's what we're going to walk you through in just a couple of minutes. In doing our scans and everything, we basically came up with one stock that we traded, and that was basically the Comcast stock, symbol is CMCSA. It was over $50 a share when we took the trade. Also had a 1.56% yield. Even though we're not going to be sitting there buying the stock, if you did want to buy the stock yourself, you could and collect a dividend, but we're more interested in dealing with options. And also, it had a bullish trend on both the weekly and the monthly chart. Here's a weekly chart for the Comcast stock. And remember what we're looking for. We're looking for a bullish trend, which you see in this scenario here, and we're looking for it to pull back on the weekly time frame. It pulled back to this green line, which basically represents a support for about 26 bars. So this is exactly fitting our criteria that we're looking for, where we have a major trend and it's at a pullback level, which is the green line. And when we first started looking at it was where it hit that green line here, and what we started doing was started looking at the lower time frames and working our way up to see if that support would hold. You do have an option where you can sit there and automatically buy without looking at the lower time frames, but what we want to do was reduce the drawdown that can happen with price going below the support. And that's one of the reasons why we wanted to look at the lower time frames and try to get the best time for this stock to buy. Okay, here's a daily chart. You could see that same level here for the weekly support here on the daily chart right there, and you could see it did bleep down there below it by a couple of like 20-30 cents. You could see on the daily time frame that initially when it got to the support, it did sit there and bleep down there and actually closed down there too, to kind of make you feel like it broke the support. And that's one of the reasons why we didn't want to buy as soon as it gets there. We wanted to see exactly what price action was going to do on the lower time frames and then determine when to buy. So what we're looking for is on the lower time frames for it to hold that support right there, and then once we see that, we're willing to buy it. So you could see here it kind of went below it, and then the next day here it kind of went below it again, but then closed back up here, and you could start to see the upward movement here. So that's the daily time frame here. As soon as this bar right here got there, we started looking at the lower time frames. So if you look here on the 30-minute, you could kind of see the price action here. You could see it got to the support here, then kind of went back and forth, back and forth, back and forth. And what we're looking for is price to sit there and get above the green line, which is acting as a resistance, and close above it and stay above it at least for 2 bars. Okay, and the reason why is a green line is a great resistance in Ichimoku, so that's what we're looking for. You could kind of see it bleep above here but not close here. This one closed above it here for 1 bar but not 2 bars, so we're looking for at least 2 bars for it to close above the green line. And you could see price is kind of playing around this support, this support right here, where it went below it, acted as a resistance, but eventually closed above the green line here for 2 bars, which was right here. So once we saw it on the 30-minute, then we moved to a higher time frame above the 30. Then we're looking for the same scenario here, where it wanted to close it 2 bars above the green line. We got the 2 bars here on the 60-minute here. And then on a 30-minute, what we're looking for is not to get above the green line, but to get above the red line in this scenario here. So over here, once we saw the 60-minute get above the green line for 2 bars, on the 120, we waited for it to get above the red line, which is roughly right about here. So once we see this, where now we have the support being held on a 30-minute, 60-minute, and 120, we're now starting to look at the option chain to start looking to buying this stock and with options. The reason why is the lower time frames are holding that support, and it's a high probability at that point where it's going to sit there and bounce off there and go up due to the fact that it was a pullback on the weekly time frame. Now, there's one of 2 options you could go down. One is where you could buy the stock. You could wait for the stock to come back to the support level to buy it, or you could sit there and buy it now and then sit there and make sure your stop is below the support here by a couple of points. Or what you could do is you could start looking at options. Since we trade options, what we're going to do is we're going to go for the option scenario for you. And here's the option chain, and you could see this is what the options look like when we first were looking at this particular stock instrument. Notice the stock price is at 57.23. The price when we started looking at this was 5/19/2015, and you could see that we're looking at October expirations, and the reason why is we're looking to buy a call. We have to exit the call 30 days before expiration, before time really kills us, and so forth. When we looked at the option chain, volatility was at its average, so that was great. So that's one of the reasons why we're looking at buying a call. And you could see here that the stock price is a 57. And what we typically do is go about 2 to 3 strikes out. So if you look 2 to 3 strikes out, you're looking at 60, 62, 60, 65 options in here. Okay, so you could see that right there. So the options we actually took were the 62.50s here, and you could see the volatility is around 18. You could see for every dollar move we're going to make $23, and our cost is going to be roughly, if you look at the midpoint between the 81 and 86, around 84 $84 a share for the options. I'll show you the actual order in just a moment. If you look at this is a date when we entered the trade, and then the date we exited the trade. You could see here that 62.50 option trade went from about 82 cents here on to, and this is when we exited trade here on July 13th. The stock option price is roughly around $3, and you could see the stock went from $67 and some change to $63. So you had a $6 movement, which is very good for the stock price and also for the option. And if you look at the summary here, you could see this is our trading account here. You could see that we bought the call here of Comcast on 5/19/2015, bought it for 80 cents, and then we sold that same call roughly almost 2 months later here for about $3.20. So we had over a 3-to-1 reward risk ratio on this trade. So remember, as we mentioned, you had an option of either buying the shares and using a stop below the support, or you could sit there, get options, and then what you do is you put alert at your stop on a chart. If it gets there, then you close out that option for a loss. In this case, it actually got to our price target, which is what we wanted to do.